What's a mortgage? Welcome to our channel. The goal of our channel is to educate, empower, and to connect you with the right mortgage. If it's your first time tuning in, hello, welcome, welcome, welcome. Turn on the notification or subscribe button so you're notified every time we go live or post new content. We go live Mondays and Wednesdays on Facebook and YouTube, and we go live Tuesdays on Instagram. And we post content Sundays and Wednesday mornings at 9 a.m. All right, guys? So, guys, do me a big favor. If you have questions regarding home ownership, tonight is the night to ask. Tonight, our most common question everyone's asking me all week is, man, I bought a home in 2020. How am I going to reap the benefits in 2021? What are my tax benefits? So tonight, guys, we are going to go over filing taxes as a new homeowner in 2020. So if you bought in 2020, I'm sure you're wondering, where are my tax benefits at? Also, guys, remember this. I am not a CPA. I'm not a tax preparer. I am a licensed loan officer. So if you have detailed tax questions, definitely ask your CPA, ask your tax preparer. I'm giving you basic knowledge that they provide us in loan officer school, right? They're not giving us additional information, all right? So hopefully you understand that. So if you're asking a question like, well, this guy doesn't know, it's a tax question, okay? So ask your tax person or your CPA. I'm just giving you the information so you can have your paperwork ready to file in 2021 your taxes to reap your tax benefits. All right, guys, let's get into it. So filing taxes as a new home owner, right? So if you bought a house or you're going to buy a house next year or the following year, you really need to know this information so you know you're not scrambling beginning of the year. Oh my gosh, I need to file my taxes. Where do I go? I need this document. I need that document. What documents do you need to file your taxes, okay? So let's get into that. So this is the information you're going to need to file your taxes. And this is some information you want to know up front before calling your tax person, right? You want your final settlement statement, which we're going to break down in a second. You want your 1098 form. You want your tax bills, right? You want to know your standard deductions in case you want to go with line itemization, and I'll break that down in just a second, okay? And also, at the end of this, I am going to give you the Self-Employed Homeowners Act, Homeowners Hack. If you are not self-employed right now, you might want to think twice about starting a little side hustle, even if it doesn't make money. You can use it as a tax benefit. All right, guys? So let's get into the first thing you need. You need your final settlement statement. If you are filing your taxes for 2021, for the home you bought in 2020, you want your final settlement statement, which is your final receipt, right? When you get a bill, and once they run that credit card, right, you get the final receipt. So this is the final receipt. You can get it from escrow. So if you haven't bought yet and you're going to buy next year, when you fund your loan, make sure you call that escrow a week later. Why a week later? All the funds are finalized and distributed. Typically, they can't get you the final HUD. They say they can, but the final settlement statement, or they call it final, they used to call it final HUD, but the final settlement statement, it takes about a week after the loan funds, okay? So if you already bought a home, right, you might want to go back, look at your escrow paperwork, call your escrow. I think you will probably get the response quicker than getting it from your lender, right? Unless the loan just funded, it's after a week, it's easy to get from your lender. But of course, you can always call your lender. But if you want it like that, you want to call the escrow company. If you do not have your final settlement statement, you definitely need it, okay? Why do you need it? Because when you buy a home, year one, you have multiple deductions, right? You have lender fees, anything that was a lender fee, miscellaneous, title, escrow, impounds, right? Those are all tax deductible. If you bought a home and you did single premium private mortgage insurance, which means you paid all up front for your private mortgage insurance the first year, it's all tax deductible, okay? Also, if you did have all these fees, but there was a lender credit for it to get paid, it's still tax deductible because you're going to pay it in interest. So remember, when you fund your loan, you wait a week, or if your loan already funded, call your old escrow company right away. Why is that? You want to make sure you get all that documentation, right? Remember, things are taking longer because of COVID. You want to get your paperwork into the IRS ASAP to get that refund, okay? So another thing to teach you guys, a lot of guys, right, use your 401k for closing costs or down payment, right? You can't do it for down payment, right? We left it there. You cannot use the down payment cannot be tax deductible, only the fees, right? So if you drew from your 401k to cover closing costs, right? Remember, when you draw from a 401k as a hardship, right, you're subjected to income tax. So let's say you wrote off 10 grand, right? Or you increase 10 grand in income, right? So you're subject to 10 grand in income, but your closing cost was 10 grand. So it kind of washes itself out. So you're not really paying income tax on it, right? But you want to make sure you have all this information. You want to make sure you have that final settlement statement. If you use your 401k, you want the copy of the distribution, right? Because your 401k is going to send you a 1099 as well of how much money you drew out of it. All right? So bring that form in. So hopefully if you did use your 401k, it will cancel itself out so you're not subjected to income tax. All right? So have all this document before you talk to your tax person, your final settlement statement. All right? So once you have your final settlement statement and you know now that you can't deduct your down payment, you can deduct all your closing costs. Is PMI tax deductible? If you make over Jenny Vick, if you make over $109,000 a month, the PMI it's partially tax deductible. If you make under $109,000 a year, your PMI is tax deductible. Okay, and we'll go over that in just a second. All right, Jenny, pump your brakes, girl. I got you. All right. So remember, we're talking about closing costs right now. All closing costs. If you paid for an appraisal, a home inspection, termite, right? Anything to get the home to where it needs to be to buy on the first year, it's all tax deductible. If you upgraded your home with anything, all that construction costs, right? Kitty cat just asked. It is tax deductible the first year. When you do as a refinance later on, I do not know the answer to that. But on a purchase, it is tax deductible the first year, all right? So now you have your final settlement statement. You have all your other receipts that you use to buy a house. Even though they give you a lender credit, remember, you're going to pay for it one way or the other through interest, right? So you want to make sure right there, you have all that document. So when you go in there, right, and we'll go over in just one second, how will it benefit you? Now you have your closing costs, right? The next step is you need your 1098 form, right? It's going to come from your lender. It's going to tell you how much interest you paid when you send out your mortgage payment. Remember, some money goes towards interest, principal, property taxes, and hazard insurance, okay? But remember, that 1098 is just going to tell you the interest portion. By law, by the end of January, your lender must provide it for you, okay? Without that, you can't validate how much interest you paid to deduct. So year one, as a homeowner, you have all your closing costs and everything you use except for your down payment, right, to buy your house. Number two, you have your 1098, okay? So now you know how much interest you paid. So now you're just driving down your tax benefit, driving up your tax benefit by driving down how much income you make, okay? Next one. Next thing you need right here, right? Here's the 1098 form. This is what it looks like. It'll be filled in. It will have your social security number, the name of the lender, right, and the interest you paid on there. That's what the form looks like. If you don't get it by the end of January, you got to call your lender ASAP, right? By law, they have to get it to you because you need it to file your taxes, right? Some lenders, they unload it the first week. But some lenders, if you don't see it coming in, you might want to call them ASAP, all right? So after you do that, after you have that page, the next thing is understand the SALT deductions. If you own a home, right, you can write off your property taxes up to $10,000, right? If your state income tax doesn't hit the 10,000, right, you have your property taxes. You can't go over 10,000. But in 2025, it's going back in for voting again, right? So of course, Trump set the rule. It's gonna last till 2025. After 2025, of course, it comes in again before people can write off all their property taxes, all their mortgage interest on top of the standard deduction, right? It changed the game. right? Unless you're buying a home at a certain purchase price. For example, if your loan amount is under 400,000, sometimes you only meet the standard deduction, which we'll go through in a second, right? But with these rules, it limits you, right? You might have to take the standard deduction. Back before the SALT rule came out, right? Everyone who owned a home passed their standard deduction because they had the standard deductions, they had their mortgage interest, and they had all their property taxes and their employee state taxes, right? That was all tax deductible. So it changed the game completely, okay? So typically, you're gonna look at your mortgage interest, right? You're gonna have 10,000 between income tax and property taxes. That's 10 grand, right? So if you, after your interest and your property taxes and the cost of the loan, if it's over the standard deduction, guess what? Now you go from line itemization. You go from standard deduction to line itemization. Okay. So here's your standard deductions for you right here, so you can see it for 2020. This is just numbers. You can go on NerdWallet, look up what your standard deductions are. Pretty much it's $12,500 for individuals, $25,000 as a married person. So think about this: if you were a single person buying a house, the standard deduction was $12,500. The state tax alone, the SALT alone, was $10,000, right? So you only have $2,500 in interest to go over the standard deduction, which you're going to have now. Typically, if you don't own a home, it's really hard to go over. I'm reading this comment here. Typically, as a single person, it would be hard to surpass the standard deduction without your property taxes, right? And without your mortgage interest. And now you have your closing cost money. So you're single, it's so much easier to hit it. As a married person, it's $25,000, but don't forget you also have your children part of your deductions, right? So it's easy to surpass a standard deduction of over $25,000 because you have your closing costs, you have your mortgage interest, and you have your property taxes, okay? That's why it's so important to know that when you own a home and the purchase price is in the 400s, 500s, 600s, most likely you're going to pass the standard deductions. So you're going to be able to deduct more, right? That means you're going to get to keep more of your money. You don't make more money. You're just going to be able to keep more of your money and get a bigger refund. Or what some of you guys can do, right? Well, I need my money now. If you make some changes to your dependents on your W-2, once you close escrow on a home, call your HR, maybe increase your dependents a little bit. You might get the same back or maybe just a little bit more, but now you have more money up front and you know you're not going to owe because you have interest to deduct, right? It all depends. Talk to a CPA before you change any dependents. Don't just listen to what I say. Call a CPA, talk to your tax person. Hey, I bought a house. This is my closing costs, right? This is how much my payment is. Should I increase my dependent? Because I would love that extra money to cover my mortgage payment, right? Some people need that. Go ahead and talk to a CPA or lawyer, or a CPA, a lawyer, or a tax member before you do that, right? But some people I know, they do that ASAP because it helps them give them payment relief, okay? That's a little tip right there. So after you know your standard deductions, you tally up your closing costs, you tally up your mortgage interest, you tally up your property taxes. Do you have more than the $12,500? Do you have more than the $25,000? If you do, the next step you should do, right, so you can have peace of mind before you call a tax person is, oh, dude, wrong slide, sorry, is check out, right? Go to NerdWallet, look up your federal income tax deduction, right? Depending on how much you make. So if let's say you made, look at that, that 22%, right? You made $60,000. Okay, let's say you made $60,000 that year, right? $40,000 is if you can get it under $40,000, it would bring down your tax bracket, right? So even though you made the money, you made $60,000. Let's say you were able to write off $30,000. So now you're paying income tax on what's it called? You made $60,000. Sorry, you made $60,000. You wrote off $30,000. You're paying taxes on $30,000 with the progressive taxes. So that's where you're saving money, right? So let's say look at what tax bracket you in, right? And seeing how much it's going to help you, right? So let's say you made $80,000 that year, right? You made $80,000, but your deductions was $40,000. So you're going to pay taxes on $40,000. On the other $40,000, you don't, right? Definitely talk to a CPA, talk to a tax preparer. But typically with these deductions, it's going to bring down how much the government taxes you on your money. And that's how the rich get richer, right? The two ways rich people get rich. They use other people's money to get rich, and they know how to get around taxes, right? Not to throw shade. Look how much Donald Trump paid in taxes the last couple of years, right? Like almost nothing. The rich get richer. The reason why the rich get richer is because they know how to maneuver around deductions. Now that you're a homeowner, you're empowered. Now you know what you need to do, right, to minimize your out-of-pocket expense and maximize your monthly savings, right? And the way to do it is through your tax deduction, okay? So some of you guys, you use all that, like you're only still hitting the minimum, right? You're still only hitting the minimum. I'm like, I'm still hitting my standard deduction. I need more deduction. Here's a hack for you right here, right? The homeowner's hack, right? You can create a business to increase your deduction. Rent part of your house back to yourself, right? Equipment you use for your business, it's all tax deductible, okay? Force your house has to be the main address of your business or where you work out of, right? And it's only for business. So if it was me, you know, I'm not saying go out there and start a OnlyFans page, but go out there and start an eBay business, right? Something you know, even though it might be a loss, you can take your rent as a loss, right? Increase your deductions. Increase your deductions, right? A lot of people do it. If you look on a Schedule C, you'll see that online 30 people write off a lot with their home, right? The more deductions you have, the less taxes you're gonna pay, right? So, and you can't do it until you own a home. So that's a benefit. Sometimes, well, you're not gonna get this huge tax benefit because of interest or because of this SALT rule, because of 10,000, but, right, you can go even Google the IRS using your home as a tax deduction, right? Talk to a CPA, talk to a tax person. Use the right strategies to deduct more after you own a home, right? You could increase a huge benefits from that. So definitely, guys, as you bought a house this year, congratulations, all right? Let's be smart with our money. Let's have all our documents ready. Let's have our final settlement statement. Let's have our 1098 form. Let's know how much we paid in property taxes, right? Right? Run it against, are your deductions greater than the standard deductions? Is it more than $12,500? Is it more than $25,000, right? How is it going to help you bring down how much you made that year? How much did you make that year, right? Did you make 100 grand, right? The standard deduction as a married, for married is 25,000. So you're really paying taxes on 75,000. Can you get that 75 down to 50 somehow or down to 60, right? A lot of times without a home, we would barely just tap the standard deduction, right? It's so hard to hit the standard deduction without mortgage interest, without closing costs, without property taxes, without creating a business to generate it as a loss, to generate, right, more deductions for you to maximize your income. Remember, minimize your out-of-pocket expense and maximize your savings, right? And the best way to do that, get them deductions. Guys, was that helpful information? If you haven't bought a home yet, remember this strategy, put it in the bank, check it out on YouTube whenever you feel like it. We're gonna be posting it next week. But these are strategies, right, that I use, that I feel like other people should use, right, after they buy a home, right? Make sure they have all this document. After the first year, you won't have your closing costs anymore. You will still have your mortgage interest and your property taxes. And if you started that business, make sure you're selling some things, right? You don't want to start it without doing some stuff. Everyone has a passion and a side hustle. If you got a passion, start that side hustle, right? And you can use this deduction. How about renting out the entire house, RJ? I'll go get through that in just 1 second. All right, guys, was that helpful information? If it was useful, helpful, do me a big favor. Hit the like button on this video. Also, if you know anyone that would feel this video is useful for them, right, please hit the share button. All right, guys? That's the type of content we bring here on Wham. Let's go some Q&A. If you have questions tonight, right, I will do my best to answer on taxes. Mortgage stuff, I got on lock. Taxes, some questions I shouldn't be answering, okay? So Sandy, Raul, what's going on? Sandy, what's going on? Jenny Vick, will it be available now if I call my lender? They won't have it yet because if you already made your December payment, they can't. Most likely they won't have it until the first week of January. All right, Jenny, you might want to call. Jenny Vick, interest and PMI tax deductible. Please define tax deductible. Tax deductible means you're deducting it from your income, right? So mortgage interest is tax deductible. When you make a mortgage payment, some payment goes towards interest, some payment goes towards principal. The principal, of course, is not tax deductible, but the interest is, right? So let's say you made 100 grand that year, you had $15,000 in mortgage interest deductions, right? Then of course, instead of paying tax on 100 grand, you're paying tax on 85 grand, right? But you wouldn't use the mortgage interest or property taxes if it's smaller than the standard deduction. If you are married, it's 25,000, right? So your single is 12,500. Single, you're gonna surpass the standard deduction all day long if you buy a house. As a married person, right? Think about this. If you tally up because you bought your home under 400, right? Your interest alone and your property taxes might not surpass 25,000. You might have other deductions that might push you above 25,000. Hopefully that will help out. But if you don't, it'd be really hard to hit that $25,000 deduction, right? So when I say deduction, Vicky or Jenny, is let's say you make 100 grand, your standard deduction is 25,000. You're really paying taxes on $75,000. But if you can increase your deduction past 25,000, let's say you increase $10,000 more, now you're paying taxes on 65,000. That's why it's called a tax deduction. Hi, Dad. Dad, am I making you proud? My dad used to do taxes, right, for Jackson Hewitt. So hopefully I'm making him proud by throwing out this knowledge. He's probably going to call and give me an earful. What? You missed this! What up, Megan? How you doing? Kitty, how does a tax work with new construction? Same thing. Closing costs. Same thing. Mortgage interest. Nothing's really different. All right, Kitty? My man, great info. Thanks, Ish. Audrey, do I need to have my contractor complete a 1099 if he does repairs of $20,000 on my rental for a tax deduction? So if you have a rental property, right? Yes, I would have your contractor. I would 1099 that 20 grand, right? Rental income is completely different, right? Or rental properties. But if you have rental property, of course, you could write off deductions on costs you spend every year on any upkeep. Okay. Bodyguard. What if I'm purchasing a new construction home by the end of this month? Will it be able to be put on next year taxes? If you close in December, it actually funds and close, then yes, you can. You have your closing costs to deduct. You can't deduct interest yet because you probably won't make a payment till February. But you have your not property tax, you have your closing costs you can deduct. All right. Hopefully that helps you out there. Did some upgrades in my house. Is that tax deductible? I know when you buy a house, it is. When you refinance or after you buy it the first year, that I do not know the answer to. All right. Hopefully that helps you out. What up, Troy? Johnson, I bought my house in 2019, but didn't close until late December. I didn't see any big changes in my taxes. So will this year there'll be a difference? I do not know. So if you close at the end, you probably didn't have mortgage interest to tax deduct, and you probably didn't have property taxes. You probably just had your closing costs, right? But you should have felt a little bit because your closing costs should have been at a decent, should have increased your deductions. But you should feel it this year. All right, Johnson? Betty, I sold my house, lived in it for 3 years, and bought a different one. What am I looking at in tax credit with my profit will be taxed? So Betty Tapia, if you own your home more than 2 years, if you made more than $250,000 in equity, you would pay tax on it as an individual. As a married couple, right, it's $500,000. Anything over $500,000, all right? Hopefully that helps you out. So 250 and 500, that is the magic number. So if you didn't make more than 250 in equity or 500, which is pretty kind of unlikely, right? Then you'd be fine. All right. You won't have to pay taxes as long as you transfer into another house, or even if you cash out on after 2 years, you're fine. What's up, Al Mercado? Art H, if your income is over 103, does that mean you cannot deduct property taxes? Forget where I heard this. So if you make 103, right? I think it's PMI is not tax deductible. The full PMI is not tax deductible after 109,000. But your property taxes, there's a limit you're gonna hit. It's gonna be 10,000, right? It's the SALT rule. So maybe if you make 103, you already made too much money. You paid over the 10,000 in your state income tax already. That's probably the reason why. All right, Art. Betty, if I work from home part of the year, can any part of that be tax deductible? If you work from home parts of the year, if you're self-employed, yes. If you're a wage earner, it could be different. It's how you set it up. So if you work from home, you set up a business, then that's tax deductible. But you working from home and you're a wage earner, but you don't have a business, that's something you have to talk to a CPA about, okay? Hopefully that helps you out there. RJ, if you rent out the entire home, I know rental properties are treated a lot differently, and that I do not have the answers for. I know certain things are tax deductible, depending on how much you collect in rent, how much you're taking losses. So it's a different strategy, right? Because you don't take losses on owner-occupied. But if it's a rental, you take losses, right? Your losses supersede your, how much you spend. Of course, the bigger losses, those are tax deductible, all right? Art, if your income is over 103, can you still deduct property taxes? So with this SALT rule, right, it's $10,000 total, okay? It's state income tax or it's property taxes, okay? So if you make 103, I'm sure you're paying over 110. That's probably why your property taxes are not tax deductible, all right? That's why you start, like Ish says, start that side hustle, increase that business, and get a business, right? Elmas, how much can you benefit if you close this month? If you close this month, you just have your closing costs to deduct. You don't have your property taxes, all right? Christian Molina, is Melrose tax deductible? From what I've heard, it is not tax deductible, okay? I'm a realtor working from home. How can I write off my office? Dave has a great question. Dave Vanessa Del Campo, I'm a realtor working from home. How can I write off my office? First, you got to either get a DBA or get an S Corp, okay? So once you get a DBA or an S Corp, right, you can go on the IRS website. Certain square footage of your home is tax deductible if you mainly work from home. All the equipment that you use in that room for your work, it's also all tax deductible. Hopefully that helps you out. Anna Hernandez, I just refinanced my home. I inherited my first payment is due January 1st. Do I claim it in 2020? You'll claim it in 2021. Kitty Cat, lender says 6 months after closing on a new construction, supplemental tax bills come in the mail. That is correct. See here, Alan R, what's going on? Nor, see here, does not PMI deduction end this year? That I do not know, Zode. Right now, I know that you can, if you make under 109,000, PMI is still tax deductible. Over 109,000, a portion of it is tax deductible. That I do not know, Zode. Christy Stidham, if I sell my Mercury or eBay, if I sell on Mercury or eBay, that's considered a home business. That is correct, right? That is absolutely correct. Alexandra Martinez, bought a home, closed late May. Do we benefit? If you close late May, yes, you benefit because you have your closing costs, your mortgage interest, and your property taxes, okay? Wilmer Posado, hi, Min. Is supplemental taxes tax deductible? The answer is yes, it is tax deductible. Remember, up to $10,000, all right? Hopefully that helps you out. Kitty, that tax bill scares me. I completely understand, Kitty. Typically, when you buy a house, you will have between 1 to 2 supplemental taxes. After that, you should be fine. The only hiccup sometimes is the lender, right? But when they requested for the tax rate, right, they didn't get the updated tax rate yet or the updated assessment. Sometimes they tax you on the incorrect number, and you might get a bill, and they might adjust your monthly payment to adjust to your reassessed tax value, okay? Carlos Granados, how often do I have to pay tax assessment? So if you bought a home, you will pay supplemental taxes between 1 or 2 times. But if you do any upgrades that require permits, let's say you bought a home, you pay your supplemental taxes. 10 years later, you do an upgrade that requires permits. They'll reassess your property. They'll increase your property taxes, and you'll pay supplemental taxes again. Or if you add anyone else to title, right? If you add, let's say, you add someone who's not the grandson, granddaughter, or son or daughter, they can change your taxes. If you had a cousin or an uncle passes on a house to you and they put your name on it, since they're not a parent or grandparent, you will pay the new assessed taxes, all right? Raylene, teachers working from home, can they claim a portion of tax deduction? That I do not know, right? There's something called a, oh my gosh, I'm going blank. There are certain portions of it. I know as a lender you can't do it. But as a wage earner, there is a portion that you can write off on your deductions. I just don't know teacher rules, but as a loan officer, they won't let us write off. Like, let's say you're a W-2 loan officer, right? They won't let you write off business cards or any of those expenses. The company you work for normally does the deductions, right? But other like, farmer insurance and you work for insurance companies, they allow people to have deductions as W-2. But typically, most of the people who are deducting stuff on W-2, Raylene, are in the sales business, right? So but definitely talk to a tax person, okay? Steve Coe bought a house in September 2020. When does the supplemental tax come? Within 6 months, but sometimes these the assessors are behind because of COVID, so it might be even a little longer right now. All right, hopefully that helps you out. Spirit Works. What about removing people from title? Will you have to pay tax again when refinancing? If you remove someone from title, right, but you don't add anybody, you're fine. But if you add a new person, they will reassess the property. All right. Carlos Gronas, thank you. I bought my house in August for 4K. Okay, cool. I'm not expecting it. Wilmer Posada, do I have to pay supplemental taxes when refinancing? Yes, you do. If you refinance, you have to pay your supplemental taxes, or there will be a lien on title. The lender will make you pay it. Okay. All right, guys. Hopefully you enjoyed the information. You enjoyed the content here on What's a Mortgage. We're trying to bring you content that other lenders aren't bringing you, other realtors aren't bringing you, other real estate influencers aren't bringing you. So hopefully you enjoyed it. I really appreciate everyone who watched, who liked, who shared. One last thing. I think I answered that question already, Wilmer. All right, guys. Enjoy the rest of the night. Thank you guys so much. I will talk to you. Jamie, last question. Bought a house back in September, and I already got my supplemental tax bill. Okay, cool. Every county moves differently. So, every county is just different. That's all. All right? Enjoy the rest of the night. We want to end all our episodes with our attitude is gratitude. Without you, there will be no us. And remember, guys, if you're serious about home ownership or you have questions, call us 714-909-1533, or you can email us at info@whatsamortgage.com if you have a loan estimate that you want us to review, right? And you want to make sure you're getting a good deal, or you want to shop it, please send your loan estimates to info@whatsamortgage.com. We're saving people thousands and thousands of dollars. I saved a guy about 10 grand in closing costs, right? Another lender gave him the same rate that we gave him, but with covering his closing costs up to 10 grand. So now he has $10,000 for a washer and dryer, for a refrigerator, and a new TV, right? It sucks moving into a home and realizing you had no more money. And trust me, you're going to need some money in hand. So I don't care what your realtor says. I don't care what your lender says. If you're not in escrow, or if you're in for the first week, if there's a better deal that's going to save you some money to cover your washer and dryer, to cover your refrigerator, to cover TV, or change the flooring, or change the paint, do it, right? A couple $1,000 is a big deal. I'll just refinance later. What happens if rates don't drop, right? Like I said, so definitely reach out to us, right? 714-909-1533 and info@whatsamortgage.com, and have a great night, guys.
We can hear outro again, but in full screen.
Okay.
Attitude's gratitude.
Again, oh my God. He wants to say this, right? Again, guys, we want to end all our episodes with our attitude. Our attitude is gratitude. Without you, there would be no us. So thank you so much.